Meta is one of the best performing stocks this year with an eye-popping year-to-date return of 68%. That is almost triple the S&P 500. It dominates social media with 3.3 billion daily active users, and it has a market cap of almost $1.5 trillion. So, is it time to invest in this social media superstar, or should you hold off and wait for a pullback? Let's dive in and find out. I'm going to cover 4 points in this video, but for those of you who want a deep dive, I cover more in my school community. Check out the link in the description. All right, point one, background/business model. The bulk of Meta's revenues come from advertising and their family of apps, which is Facebook, Instagram, and WhatsApp. But they also have Reality Labs, which is their push into augmented and virtual reality, aka the metaverse. We're going to dive into all of it. Part two, AI and the future. So in the recent earnings call, Mark Zuckerberg talked about the company's AI and metaverse efforts, and I've highlighted the most important points just for you. Part 3, 2Q24 results and a look ahead to 3Q24. Meta's 2Q24 results showed strong ad performance and a recovery in digital ad spend. Metaverse's investments via Reality Labs continue to weigh on profitability, but management is confident in the long term. Part 4, valuation. So Wall Street has Meta at a high valuation of $811, which is a 39% discount, but are they right? So on Wall Street, we build three-statement financial models culminating in a discounted cash flow or DCF valuation. I've built a three-statement model and think that Meta trades at a discount at current levels, and I can't wait to give you all the details, so let's dive right in. If you're enjoying this, please smash that like button. All right, company background. Imagine a dorm room in early 2004 where a young student launches a website that would soon reshape how the world communicates.
Mark, if somebody was to put the question to you about the magnitude of what you think you've launched, how big do you think your product or your service is?
Well, it's impossible to tell. When we first launched, we were hoping for, maybe 400, 500 people. Harvard didn't have a Facebook, so that's the gap that we were trying to fill. And now we're at 100,000 people, so who knows where we're going next.
Little did he know that platform would transform from a simple social network into a digital empire. But what exactly led Meta from those humble beginnings to becoming one of the most influential companies in the world? Founded in 2004, Mark Zuckerberg founded it as Facebook. It was initially a social networking site just for Harvard students. He rebranded it as Meta Platforms in 2021, signaling its shift towards the metaverse and virtual reality ambitions. Meta's ecosystem now includes Facebook, Instagram, WhatsApp, Oculus VR, and Horizon Worlds, and has almost 3.3 billion daily active users. They're headquartered in Menlo Park, California, with global reach across social media, advertising, and virtual and augmented reality industries. All right, the business model. How do they make money? Have you wondered why Meta's platforms, which you use daily, are free? If billions of us aren't paying, then how is Meta raking in billions every quarter? There's a fascinating answer hidden in the scrolling, tapping, and liking that we do every day. So Meta's primary revenue comes from advertising. Approximately 98% of total revenues. They leverage their vast user data to target ads effectively. They offer businesses ad placements across Facebook, Instagram, Messenger, and WhatsApp. Meta collects user behavior data to create highly targeted advertising opportunities. Other revenue streams include Oculus VR sales, digital goods in the metaverse, and some hardware sales like Portal. All right, part 2, Meta's AI revolution 2024 and beyond.
The future is now!
So picture this, AI doesn't just predict your next move, but creates entire experiences for you. Meta's playing a high-stakes game with artificial intelligence, but what are they really up to? Meta's AI master plan, the silent game changer. While everyone's been talking about the metaverse, Meta's been quietly working on something even bigger. AI could be their secret weapon, but what's their end game? Generative AI. Meta's building AI that creates, posts, stories, videos, automatically tailored for each user. Llama models. Meta's Llama AI models have become serious contenders in the AI race, with Llama 3 making waves in 2024. AI-driven personalization. Everything you see is now smarter thanks to Meta's AI fine-tuning your experience in real time. But how will this AI shift boost their advertising and user engagement? Hang tight, we'll get there. AI-powered ads, Meta's money machine. Ever wonder how Meta turns your scrolling into profits? It's AI, and it's getting smarter by the day. But can they outsmart their competition? Targeted ads. So Meta's AI supercharges ad targeting, making ads more relevant and driving higher conversions. AI-powered content for advertisers. Meta's AI now creates custom ads and optimizes campaigns faster than ever, making life easier for advertisers. Recommendation engine. In 2024, Meta fine-tuned its AI algorithms, pushing engagement to new levels across Facebook, Instagram, and WhatsApp. But can this keep Meta ahead of TikTok and YouTube? Let's dig into that. AI in the metaverse, the key to unlocking virtual worlds. The metaverse hasn't taken off like Meta had hoped, but AI might be just the missing piece. Could it be the catalyst for the metaverse to explode? Smarter avatars. Meta's AI now powers avatars that interact in real time, making virtual worlds feel more alive. Personalized worlds. AI shapes metaverse experiences to match user behavior, creating unique virtual environments. Developer tools. Meta's AI tools help developers build metaverse content faster, aiming to make these worlds more attractive and functional. But will this really make the metaverse mainstream, or is it still too soon to call? 2024 has been a turning point for AI at Meta. But what breakthroughs could change how we interact with the internet forever? AI and content moderation. So Meta's new AI models detect harmful content faster, keeping the platform cleaner with fewer human moderators. AI-powered shopping. Personalized shopping is now on another level. Think AI-generated virtual try-ons and tailored product recommendations. AI in healthcare. Meta's pushing AI into healthcare with tools that help analyze patient data and predict trends. But with all this progress, what's next for Meta in AI? For users, smarter, more personalized interactions across all of Meta's platforms. For advertisers, AI-driven tools will boost campaign performance, offering better targeting and content creation. For investors, AI could be the catalyst for Meta's next growth wave, but there are still risks on the horizon. So, is Meta's AI revolution going to lead the company to dominance, or are we still waiting for the next real breakthrough? All right, part 3, Meta's 2Q24 highlights, a big quarter, AI front and center. So revenue growth. Meta reported $39.07 billion in revenue, up 22% year over year, driven by strong ad performance and recovery in digital ad spend. So the ad impressions increased by 10% and average price per ad also increased 10%. This signals a growing demand for Meta's AI-enhanced ad targeting systems. So investors should see this as a sign of increased advertiser confidence and improved ad monetization driven by Meta's AI enhancements. It's a positive indicator for future growth in Meta's core business. Meta's operating income jumped 58% year over year to $14.85 billion with an impressive 38% operating margin. Meta is showing cost discipline while continuing to invest heavily in AI and the metaverse, boosting profitability. So for investors, the margin improvement, despite increased R&D spending, up 13%, suggests Meta's focus on efficiency is finally yielding some strong results, a positive sign for future profitability. Reality Labs reported $353 million in revenue, which is up 28%, but posted a $4.5 billion operating loss. So despite growing revenues from products like Quest 3 and Ray-Ban Meta AI glasses, Reality Labs remains a drag on overall profitability. So investors need to weigh long-term metaverse potential against the continuing heavy losses. Meta's strategy to double down on AR glasses could be the key to turning the tide. Meta made substantial AI progress, including the release of Llama 3.1, an open-source AI model, and a broader rollout of Meta AI.
Today, we're excited to deliver on the long-awaited Llama 3.1 405 billion parameter model that we previewed back in April. We're also updating the 8 and 70 billion models with new improved performance and capabilities.
So Meta is aiming for Meta AI to be the most used AI assistant by year end, positioning it as a critical tool for both users and businesses. So for investors, Meta's AI enhancements in ad personalization and business messaging are boosting advertiser returns, making AI a significant long-term growth driver. So Meta generated $10.9 billion in free cash flow, up $6.9 billion year over year, and repurchased $6.3 billion of Class A stock. Meta is in a strong financial position with $58.1 billion in cash and a continued focus on returning value to shareholders. So for investors, the robust cash flow and ongoing share buybacks make Meta attractive for investors seeking both growth and shareholder returns. So looking ahead, what's next for Meta? 3Q 2024 results are right around the corner, so what should we be looking for? Number 1, ad revenue growth. Meta projects 3Q 24 revenue between $38.5 and $41 billion, indicating confidence in its AI-driven ad business despite currency headwinds. So can Meta's AI-powered ad tools continue driving better targeting and higher returns for advertisers? That's something we're going to be on the lookout for. Number 2, AI and generative AI progress. Investors should keep an eye on AI advancements and how they integrate with Meta's platforms, as this could further elevate engagement, monetization, and profitability going forward. So the key question here is, will Meta's AI investments show tangible impacts in the near term, or are they still a long-term play? 3, User growth and engagement. While Meta's user base is massive, the growth rate is under constant scrutiny. Investors want to see how Meta is performing in terms of DAU, or daily active users, across Facebook, Instagram, and WhatsApp, especially in emerging markets. So the key question here is, are younger audiences sticking with Meta's platforms, or is competition from TikTok and other social media platforms eating into its user base? Number 4, Reality Labs and Metaverse losses. So Meta's Reality Labs losses will deepen, but continued investments in AI and augmented reality glasses are expected to drive long-term innovation. So the key question is, how long will Meta keep pouring money into the metaverse before it starts seeing returns? And can they curb the mounting losses? Number 5, profitability and margins. Investors want to know if Meta can keep margins stable or growing, especially in light of ongoing investments in AI and the metaverse. The market will look closely at Meta's operating expenses and how they're managing their cost structure. So the key question here is, can Meta balance its ambitious spending while maintaining profitability, or will rising costs erode margins? Now, I cover this extensively in my school community. Check out the link in the description. Number 6, guidance for 4Q24 and beyond. With the holiday season approaching, the market will be focused on Meta's guidance for 4Q24. Strong guidance would indicate continued confidence in ad revenue growth and user engagement. So the key question here is, does Meta expect a strong finish to the year, or are there concerns about macroeconomic factors, competition, or ad spending fluctuations? Number 7, regulatory and legal challenges, especially in Europe. So ongoing regulatory scrutiny, especially around data privacy and antitrust issues, remains a concern. Investors will want to know if there have been any new developments that could impact Meta's operations or finances. So the key question here is, Meta's regulatory risk increasing, and could any new legal challenges affect the company's ability to innovate or operate globally? So in summary, the market's looking for sustained ad revenue growth, progress on AI initiatives, stabilization of Reality Lab losses, and solid guidance for the holiday quarter. If Meta can deliver on these fronts, it could bolster investor confidence and support the stock's recent momentum. Part 4, the moment we've all been waiting for, the valuation. So we'll begin with the balance sheet. The company has tons of cash, almost $60 billion, with an average of $50 billion of cash and cash equivalents over the last 7 years. The company only took on debt in 2022. They've been self-financed up until then, yet the company is still net cash by about $50 billion. Remember, net cash means cash is greater than debt. Retained earnings has doubled over the last 5 years, despite buying back almost $100 billion in shares. The company's investing heavily in AI and Reality Labs, which is virtual reality, which we're going to see next in the income statement. So what's the takeaway? They're very conservatively financed, net cash, solid balance sheet with a AA- credit rating. Let's hop in the model. All right, so as we mentioned, the company is net cash by a significant amount. You can see that up here. Debt less cash is almost $50 billion. Debt only started being taken on in 2022, and it's very manageable. Also, retained earnings has seen massive growth over the last several years and will continue to ramp on a going forward basis. All right, next we have the income statement. Revenue has grown 2.4x in the last 5 years. They have over $135 billion in revenues. They have big investments in AI and Reality Labs, $130 billion over the last 5 years and $38 billion last year. They've been reinvesting in the business and returning capital to shareholders. We're going to see this next in the cash flow statement. Gross margin is about 90%. Remember, advertising is a service, not a product. Net margin is about 30%. So this is a very high margin business. They are net interest positive, which means interest income is greater than interest expense by about $1.2 billion. That's remarkable. Over the last 4 years, revenue is up 1.9 times, while net income is up 2.1 times. This shows positive operating leverage. Remember, revenue is what you make, net income is what you keep. So what's the takeaway? The 5-year average return on invested capital is 24%. Return on equity is 25%. These are sky-high returns for a $1.5 trillion market cap company. I cover this extensively in my school community. Check out the link in the description. The company is growing rapidly with a 5-year average revenue growth of 20%, and they're investing heavily in R&D. Let's hop in the model. All right, income statement, incredible growth in revenue. We see over the last 4 years, 1.9x. They have almost $135 billion of revenues. Their R&D, they've been plowing a ton into R&D, about $130 billion over the last 5 years, $38 billion last year alone. Also, even though they took on debt starting in 2022, the company is still net interest income, meaning interest income is greater than interest expense by $1.2 billion, And net income has continued to ramp as well. We mentioned that net income is growing at a faster pace than revenues. Remember, revenue is what you make, net income is what you keep. This is a sign of positive operating leverage. All right, next we have the cash flow statement. So free cash flow has tripled in the last 5 years, while operating cash flow has more than doubled. The company recently announced a dividend of $5 billion in 2024. They're returning capital to shareholders, $103 billion of share repurchases over the last 5 years, and they're reinvesting in the business. They've done $108 billion of capex over the last 5 years, and they have $240 billion planned over the next 5 years. They're making tons of money off of their cash as well, with $107 billion of positive cash flow over the last 5 years. Now, this is cool because they're using this to buy back shares rather than net income. So what's the takeaway? Cash is going to 5x by 2028 if the 5-year average trend continues. And they're projected to invest over $240 billion in capex over the next 5 years. Let's hop in the model. All right, so as I mentioned, massive increase in free cash flow over the last 5 years, also massive increase in operating cash flow. Something to take note of, they've been investing the tons of cash that they have on hand. $107 billion has been generated over the last 5 years. In terms of share repurchases, they've repurchased about $103 billion over the last 5 years. And by the end of our model, cash is projected to increase 5.2 times. That's absolutely mind-boggling. Okay, forecast drivers and DCF assumptions. So savings from SG&A has been plowed into research and development, yet they've still shaved 2% over their cost structure overall, which is almost $3 billion worth of savings. That's tremendous. R&D is above its tech peers, approximately 28% of revenues. This is because they're investing in innovation via Reality Labs. Remember, that's where they focus on AI and VR. They have very high capex, over 20%. This is a sign that they're reinvesting in the business. They have a moderate beta for a tech firm, only 1.25, and a very reasonable WACC, under 9%, 8.9% to be specific. So they have low leverage, 1.2%, and a AA- credit rating. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. All right, so in terms of the forecast drivers, we can see over the last 5 years, 20% average top line growth, which is absolutely incredible. But also, they've been able to save on costs. If you look, the combination of these three OPEX are 48% 5 years ago, only 46% today. That was a $3 billion savings. Also, they're ramping up CapEx. Management has said that CapEx is going to be pretty significant on a going forward basis. We take a look at what is going into our DCF model. We see that they have a beta of 1.25. Remember, the stock is 3x over the last 5 years, 7x over the last 10 years. They have a AA- credit rating, very low leverage, and look, almost $60 billion worth of cash and cash equivalents. Now, one thing that we have to touch upon, which is very important, is the terminal multiple. Remember, that's the value from the end of the model out into infinity. So their current TEV to EBITDA is 18.5 times. I went with 16 times. Now, if I open up the note here, we could see that the comps are at 20.6 times. And over the last 15 quarters, the average for Meta has been 6.25 to 18.95. So choosing 16 is still on the higher side, but I think it's not unreasonable considering AI and the metaverse growth. All right, DCF valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. Remember, future cash flows are discounted back to today to get to TEV, or total enterprise value. We strip out net debt to get to equity value. The company is high growth, has lots of cash, big investments, and a push into AI, but is it worth buying today? The stock is up more than 85% over the last year. Now, Wall Street has Meta at an average of $610, which is a 5% discount. But what does our analysis show? Let's hop in the model. All right, y'all, DCF time. Whoop, whoop. So we got EBITDA less DNA. That gives us EBIT less cash taxes. We get EBIT or NOPAT. We add back DNA. We take into account changes in operating working capital. We have CapEx. Then we get free cash flow to the firm. Remember our terminal value, which is the terminal EBITDA multiple times the terminal EBITDA. So that's 16 times terminal EBITDA. We have our cash flows to discount. We multiply those by the discount factor. We get the present value of cash flows, which leads us to the total enterprise value. We strip out debt. We add cash, we strip out non-controlling interest, we add in associate investments, we get an intrinsic equity value of $1.54 trillion. Divided by the current shares outstanding, we get an implied share price of about 609. Compared to the recent close of 582, that's about a 5% discount, which is a hold rating. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 14 out of 50, or 28%, showed a sell rating. 35 out of 50, or 70%, showed a hold rating. 1 out of 50, or 2%, showed a buy rating. We ran each of the 3 scenarios equally weighted. We got a weighted average value of $612, which is a 5% discount. So what's the takeaway? Utilizing conservative assumptions, we show a discount, but it is a hold rating for the stock. It's at a discount, but it's not considered cheap. Let's hop in the model. All right, so as I mentioned here, the bulk of our analysis shows a hold rating. We see that 70% of this is a hold rating. Looks like a ketchup and mustard fight. Ultimately, only 2% or one scenario shows a buy rating. Right now, the valuation is a little bit frothy. All right, scenario analysis. Remember, we ran a bear base and bull case. We equally weighted them. We actually get a sell in the bear case, a hold in the base case, which is the case that we're running, and a buy in the bull case. We get a weighted average about $612, 5% discount, which is a solid hold rating. The wrap up. So Wall Street has Meta at a high of $811, which is a 39% discount, an average of $610, which is a 5% discount, and a low of $425, which is a 27% premium. Our analysis showed Meta at a value of around $609 to $612, which is about a 5% discount. Now remember, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I currently do not have a position in Meta. I like the company, but I can't seem to get it at a reasonable price. It's only at a slight discount. For me, I would want to get in at about 500, which the stock did pull back to as recently as late July when it traded as low as 453. The valuation is at a slight discount, and considering the long investment runway, I'd be on the lookout for pullbacks if you want the only pure play social media stock out there. Meta is a social media juggernaut with almost 60 billion in cash, very little debt, a AA- credit rating, and over 240 billion of capex planned for VR and AI over the next 5 years, and I'm super excited to see what they do. Now, if you want to go deeper and get direct access to me, check out my school community. The link is up in the description. And if you like this and want to see another stock analysis, check out my Alibaba video here or my super microcomputer video, which you can find here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.